What's coming is not just another economic crash. What's coming is something deeper, something structural, something that will shake the very foundation that gives your money its meaning. For years, the idea of a crash has been tied to images of falling stock charts, failing banks, collapsing markets, headlines filled with panic, and politicians promising fast recovery. That is what people expect. That is the crisis they understand. They think of 2008, the dot-com burst, the debt crisis, inflation spikes, or recessions that came and went. But the next event will not follow the familiar pattern. The problem brewing right now is not one market, not one bubble, not one reckless asset class. It's the system itself. The system that assigns value to your salary, your savings, your investments, your home, your pension, and every decision you make with money. So make sure to stay until the end to understand what's really happening. Leave a like, and let's start. The first sign that something bigger is coming is the breakdown of the tools that used to fix economic problems. For 4 decades, whenever growth slowed, central banks cut interest rates. Cheap money stimulated the economy, borrowing became easier, investments grew, and confidence returned. When that wasn't enough, governments injected liquidity. When that stopped working, they printed trillions. If you look at a chart of global interest rates from the 1980s to the late 2010s, the curve falls almost in a straight line. If you look at global debt, the line rises sharply. Cheap money inflated the economy, but it also created dependency. The entire system grew addicted to lower and lower rates. But here is the issue no one wants to face. We reached the mathematical bottom. Rates cannot go much lower without destroying currency stability. Debt cannot rise much further without threatening government solvency. Money printing cannot be repeated at the same scale without risking inflation spiralling out of control. All the tools that once saved the system are now dangerous to use. That alone should terrify anyone who understands how fragile modern economies really are. Inflation is the clearest warning. And no, it is not the temporary, transitory inconvenience authorities claimed it would be. You can feel it every time you shop for groceries, pay rent, renew your insurance, or fill your car. Prices rise faster than wages. Essentials consume a larger part of income. Savings lose value, even when the number stays the same. This kind of inflation is not a phase, it's structural, meaning the system itself is producing it. Why? Because governments have been forced to issue record amounts of debt, and central banks have indirectly supported it. When a currency increases in supply faster than the real economy grows, purchasing power falls. That is not speculation, that is mathematical fact. If you plotted the money supply from 2020 onward, you would see a historic explosion. If you plotted real wages over the same period, you would see stagnation or decline. Those two lines moving in opposite directions tell the story of what is actually happening. The currency is weakening. The cost of living rises because each unit of money buys less. That is the early stage of a monetary event, not a normal cycle. Just a little break, I opened a free Telegram community where I teach how to earn money with YouTube and build channels like the one you're watching. If you want to understand how to do it, there's the link below, back to before. The next sign is the behaviour of markets. Look closely. Tech giants represent an absurd share of total market value. Investors are pouring into anything that feels scarce, durable, or resistant to inflation. Gold is rising. Digital assets are rebounding. Commodities are becoming attractive again. In normal times, these moves might seem speculative. But during periods of weakening currency confidence, they are defensive. Investors aren't chasing profits. They're escaping a devaluing unit of measurement. If you examine historical inflationary collapses, Weimar Germany, Argentina, Turkey, Venezuela, you notice something counterintuitive. Stock markets often rise dramatically in nominal terms. People think they're getting richer because the numbers go up. But they can afford less. The currency collapses faster than assets appreciate. This creates a false sense of security, a psychological trap that convinces people everything is fine, right until it's too late. We are not in hyperinflation, but the underlying mechanics, the debt levels, the money creation, the loss of trust, mirror the early stages of every major monetary decline ever recorded. Now consider the position governments are in. If they raise interest rates to fight inflation, they increase the cost of servicing their own debt. If they keep rates high, they risk breaking housing markets, banking sectors, and corporate lending. If they lower rates, inflation accelerates again. If they print more money, they lose even more credibility. If they stop printing, the economy stalls. Every path leads to instability. This is what economists call a policy trap, and the world's largest economies are trapped right now. Another critical sign is what central banks themselves are doing. They are buying record amounts of gold. They are moving away from US treasuries. They are preparing alternatives to the current global settlement system. Meanwhile, countries are striking energy and commodity deals denominated in currencies other than the dollar. These are not normal developments. These are signs of a world slowly preparing for a shift in monetary order. And through all of this, the middle class, ordinary people, families, workers, savers, are standing directly in the line of fire. The wealthy have real assets that survive inflation. Real estate, businesses, commodities, land. The poor have little to lose. But the middle class stores wealth in cash, bonds, savings accounts, retirement funds, and government-backed instruments. These instruments collapse first in a currency crisis. The nominal value might remain, but the purchasing power evaporates. This is why the next crisis will not look like 2008. It will not be a sudden crash followed by a clean recovery. It will look normal at first. Markets will remain high. Politicians will speak confidently. Experts will say the worst is behind us. But the currency will weaken in the background slowly and silently until trust collapses. And once trust collapses, the crisis accelerates. When trust breaks, nothing behaves normally anymore. Markets stop reacting to data and start reacting to fear. People pull money from banks not because they need the cash, but because they stop believing the cash will hold its value. Governments deny instability right until the moment they are forced to make dramatic announcements. Policy becomes unpredictable. Emergency measures become standard. Confidence evaporates in days, sometimes hours. And once that psychological barrier collapses, the system enters a completely new phase. In this phase, asset prices rise for reasons that have nothing to do with economic strength. They rise because people are fleeing the currency itself. They rise because investors prefer owning almost anything over holding cash. They rise because scarcity becomes more important than growth. Gold does not surge because mining output changed overnight. It surges because people want safety. Energy does not rise because consumption suddenly skyrockets. It rises because it is tangible and essential. Even technology stocks inflate not because earnings suddenly expand, but because capital escapes weakening money. These reactions signal a loss of trust, and once trust is gone, regaining it becomes nearly impossible. The next stage involves government intervention. Historically, when currencies weaken, governments tighten control. They impose new regulations on banks. They restrict capital flows to keep money from leaving the system. They declare emergency measures to limit withdrawals or foreign exchanges. They create new digital currency frameworks to track and influence monetary movement. All of these steps are presented as solutions, but in reality, they are indicators that the system is deteriorating. No government implements strict financial controls during stable times. They only appear when instability has already taken hold. At the same time, ordinary people experience the crisis differently. They see the cost of living rising faster than their salaries. They see rent becoming unmanageable. They see their savings buying less every month. They see friends and family taking second jobs. They see businesses cutting staff, reducing hours, or closing entirely. The crisis does not feel like a single breaking moment. It feels like a long slide in purchasing power, a gradual tightening of daily life. People feel poorer before they understand why. And by the time they understand, the process is already too advanced to reverse. Then comes the realization phase. This is the moment when people finally recognize that the system is not functioning the way it used to. They notice that inflation does not return to normal levels. They notice that housing is becoming permanently unaffordable. They notice that governments cannot balance budgets. They notice that debt never stops increasing. They notice that central banks contradict themselves with every announcement. In this phase, uncertainty becomes the new normal. Every new data point triggers speculation. Every policy decision triggers volatility. Every unexpected event becomes a potential catalyst for collapse. When enough people reach this realization, The crisis shifts from slow deterioration to rapid acceleration. Bond markets begin to break because investors demand higher yields to compensate for inflation risk. Stock markets swing wildly because traders try to predict interventions before they happen. Housing markets freeze because buyers can no longer trust long-term financing. Banks become hesitant to lend. Companies delay investments. Households cut spending. The economy does not implode instantly, but it becomes paralyzed. A system built on confidence cannot function without it. The global implications are even more severe. The world economy is interconnected, meaning the failure of one major currency affects everything tied to it. Trade contracts need stable exchange rates. Debt markets require predictable interest rates. Supply chains depend on stable financing. When a reserve currency weakens, every nation that interacts with it feels the shock. This leads to geopolitical tension as countries compete for resources, influence, and monetary advantage. Nations with strong commodities strengthen. Nations dependent on imports weaken. Alliances shift. Strategies change. A monetary crisis becomes a geopolitical crisis. But here is the hidden twist. Every major monetary collapse in history has also been a wealth transfer. Just a reminder, I opened a free Telegram community where I teach how to earn money with YouTube and build channels like the one you're watching. If you want to understand how to do it, there's the link below, back to before. Wealth does not vanish. It moves. It moves from those who hold assets denominated in weakening currency to those who hold scarce value. It moves from those who trust old systems to those who anticipate change. It moves from passive savers to active planners. The pattern repeats in every era. Those who cling to the familiar lose, and those who adapt quickly position themselves for the next cycle. This does not mean panic is the solution. Panic destroys rational decision-making. What matters is understanding the difference between temporary market noise and structural monetary stress. Temporary crashes recover. Monetary transformations reshape everything. You are not preparing for a dip in the market. You are preparing for a multi-year evaluation of what money represents. You are preparing for a world where financial rules shift, where old assumptions die, and where new systems emerge. In the late stages of the crisis, governments attempt resets. Sometimes they revalue the currency. Sometimes they restructure debt. Sometimes they introduce a new form of money entirely. These resets are portrayed as stabilizing measures, but they confirm the reality that the old system could not survive. After the reset, society does not return to the previous normal. It enters a new era defined by different constraints, different opportunities, and different rules. And here is the part most people never understand until it is too late. The transition is survivable. In fact, it is possible to come out stronger on the other side, but only if you see the shift before the crowd does. Only if you understand that what's coming is not a storm you hide from, but a cycle you navigate. Only if you recognize that when currencies weaken, scarcity becomes the anchor. Hard assets become the foundation. Real value becomes the shield. The system may change, but the laws of value never do. So the question is not, will there be a crash? The question is, what kind of crash? A market crash is painful but recoverable. A monetary crash is transformational. And the signs are clear. Rising inflation, record debt, loss of purchasing power, dangerous fiscal deficits, stress in bond markets, central banks buying gold, nations preparing alternatives, people feeling poorer. These are not random data points. These are indicators of a system nearing its limit. This is why what's coming is worse than just an economic crash. It is a redefinition of wealth. It is a restructuring of stability. It is the end of the cycle that began decades ago and the beginning of something entirely new. And those who understand this early will not be afraid when the transition arrives. They will be prepared. They will be positioned. They will not cling to the illusion of safety. They will build real safety. Because the truth is simple. Money can be printed. Value cannot. Systems can fail. Reality does not. And history has shown again and again that those who recognize the difference are the ones who rise during the fall. Smash that subscribe and like button. Let me know your thoughts in the comments. And I also want to remind you that if you want to build a YouTube channel like the one you're watching now and make money from it, I opened a free Telegram community with the link below. See you there or in the next video. Just a reminder, I'm not a financial advisor. This video is for educational purposes only, and any results depend on your own decisions and actions.